Pay will invest $13 million in Zimbabwe's TM stores, raising its stake in the supermarket chain from 25 to 49%. This investment has received the approvals from the Reserve Banks of Zimbabwe and South Africa, as well as other relevant authorities. TM will utilize the $13 million investment to update and refurbish existing stores, and the public will notice changes in TM supermarkets in the coming months. In other news, the South African Commercial Catering and Allied Workers Union, SACAWU, has cut a deal with Pick n Pay to save more than 3,000 jobs by allowing more workforce flexibility. Ron, let's start with this $13 million deal approved by Zimbabwean regulators. It's consistent with Pick n Pay's expansion plans on the African continent, and they're going to be raising their shareholding, as I said, from 25 to 49%. They've also opened a third store in Zambia, and it's one of 5 planned for that country in the next 4 years. Touch on the attractiveness of the SADC region, and also give us your comment on the fact that if they focus too much on Africa, they could potentially drop the ball here in South Africa, and their greatest focus should be on improving margins in SA.
I think they can do both simultaneous there. I think the worst is over for Pick n Pay. They've already taken some bad knocks. We saw those results come out with earnings down about 39 odd percent and the like. I think the company is in turnaround mode. To me, this is a classical MBA turnaround situation. Why I say that, let's touch on Africa briefly first of all. The Africa expansion is good. We've seen what ShopRite has done in Africa in terms of their growth. The margins are significantly better than in South Africa. Pick n Pay are a bit late. They're starting on that route, getting those higher margins. With a transition and change in Zimbabwe in due course, I think we will see that growing very, very significantly. The economy is dollarized. They are importing a lot of foods from South Africa and the like. Zambia with resources is a growth area. They're doing joint ventures in Mozambique there as well. They have stores in Lesotho and Swaziland, the like. I think they're also in Namibia and targeting possibly in due course places like Angola. This is going to help increase margins.
Because it sounds like Ron is saying, in a nutshell, that Pick n Pay is the model rebound stock. Would you agree with that? I mean, they're starting to become cash generative. They generated 900 million rands, up from a negative 486 million rand in the previous period. The real question is whether and when there will be an earnings recovery for Pick n Pay. But would you agree with this whole turnaround that Ron is talking about? Are they the ultimate rebound stock?
I think that my view has more to do really with who management is and who determines the direction of the company. So my view is that the Ackerman family has been very good retailers in South Africa and in other places in the world for a very long time. There's no reason to believe that in the long term they won't continue in that tradition. So whenever the stock comes under pressure, and there will be good reasons why the stock is under pressure in the short term, the question is, can you work through those? And the answer in my mind is, as long as the Ackerman family has the major say in Pick n Pay, I'd be a happy shareholder.
You'd be a happy shareholder. Let's touch on the agreement reached with SACAWU now, which can be seen positively, but it's ironic the fact that, despite the fact that Pick n Pay staff benefits rank among the top 5 companies in SA, they still remain the biggest strike target. Could you give us your comment on this agreement? And the fact that they have above average remuneration schemes doesn't seem to be getting them any productivity or loyalty benefits from their employees. Therefore, why continue on such a path?
One of the worrying things about Pick n Pay has been the fact that they've been a major target for the unions in spite of actually paying better, etc., etc. So I think that I really like this agreement because it says they are trying and succeeding in fixing their relationship with the union. Because if you're being targeted in spite of paying more than other people, there's something wrong in your relationship. But this kind of agreement says that relationship is starting to be fixed. We're working together to retain jobs, but also increase productivity at the same time, which makes for a sustainable future. So I think it's very good news for Pick n Pay shareholders.
I'm going to give you a little bit more time, Ron, because I know that Pick n Pay is your stock pick. I just want to stay with Wikus on this one and ask, in the mid-1980s, they opened up a store in Brisbane, Australia, then had a second follow-up store in Melbourne, but they had to shut that down because of international pressure based on apartheid. Then in 2001, they re-entered Australia by purchasing Franklin. Now we know that they've just got rid of Franklin and Metcash is now going to be taking over. If management were to write a book called Lessons from Australia, what would chapter 1 be for Pick n Pay?
Chapter 1 for all South African companies across the board would be very careful of developed markets, because developed markets have very strongly organized competition, whereas the competition in developing markets may be much less strong, and South Africa is actually a country with a developing and a developed part. So actually a lot of innovation that works in developing countries comes from South Africa. So developing countries is where South African companies should look for the expansion, and that's why also the whole focus on Africa is probably much more productive than going into places like Australia, Britain. I mean, if you look at what Old Mutual did in the United States, it's a nightmare.
Well, the share price closed up today from 44.61 on Friday to 45.06 today. So clearly quite a hottish day in terms of trade today. Do you give it a hot vote or not, Wikus? Pick and Pay?
Yes.
Definitely hot for you. Ron, it is your moment of glory. We know that you're going to give Pick and Pay a hot because it's also your stock pick. Tell us why you like it so much.
Again, let's refer to the Franklin scenario. They paid their school fees. We know Africa expansion with greater margins. We also know that this is a landslide agreement in terms of the labour flexibility agreement. It means, first of all, that the temporary staff who work on weekends at much higher pay and lower productivity are no longer required. It also means in terms of retrenchment costs, they're going to be significantly less. I think people who took the package, maybe about 400, 450 people. In addition, I would suspect there is attrition by people who've been with the group for many, many years, who are slowly being phased out. Pick and Pay employs about 36,000 people. They have one of the highest cost-to-income ratios in the industry relative to their peers, like ShopRite. This is slowly but surely being addressed. When you look at the numbers for the year, and that to me was an all-time low, in terms of their loyalty shopper card, they grew top-line income about 7.5%, but expenses went up about 13.5%. To me, most of that is a non-recurring item in terms of mainly the shopper card and other operations. So I believe that you're going to see gross margins starting to expand. They were down from about 17.9 to 17.7. I believe that with food inflation starting to come through now in double-digit figures, it was when they reported for the period to August about 3.5%. This is going to be a major, major kicker in the turnaround of Pick and Pay.
I really hate to cut you short, Ron, but we have to get to Wikus' stock pick. What have you chosen for us today, and tell us why?
Brickor, which is actually quite a small company and not necessarily heavily followed by analysts, but if you read Brickor's results, they've had very bad results. But they are in a turnaround phase, and one of the sentences in the report is, "We have now started to mine coal." Now, what happens with bricks is you take out the clay for the bricks, and then once you've taken out the clay, lo and behold, below it is coal. So Brickor is about to turn into a coal company, and it's not rated like a coal company. So I think there's a fantastic opportunity to buy some shares.
Now, Wikus, I don't mean to be rude or facetious in any way. You've just said that it's a small company. They came out with bad results, and now they're going to be going into coal. Did someone hit you on the head with a brick in order to choose this as your stock pick? Why?
I just think that they are rated like a brick company in the middle of a recession in the building industry, and they're actually turning into a coal company, which is a fantastic place to be because of the very high price that's being paid for coal at the moment.
Positioning yourself strategically, I see.
I think that I just think it's a risky play, but I think there's massive potential in the sense that it's very cheap and it doesn't actually discount this whole coal thing at all.